The Fed put is back. But it doesn't look like it used to. No rate cuts. No big announcements. Just quiet moves behind the scenes, and markets are watching every one. So what is the Fed put? The term started decades ago, when markets believed the Fed would always step in to save stocks during a crash. It's like a put option in trading, protection on the downside. When things got ugly, the Fed would cut rates or inject money into the system. That was the old Fed put. But today, the put looks different. It's not just about stocks anymore. Now it's about keeping bond markets stable, long-term interest rates in check, and making sure the financial system doesn't freeze up. One of the biggest triggers? Leveraged trades from hedge funds, like the basis trade, a massive position tied to Treasury futures that can break down fast when funding dries up. We covered that in a previous video, check it out if you want the full story. So how does the Fed actually pull off the modern put? Let's break it down. First, QE and QT. Quantitative easing is when the Fed buys long-term bonds to bring rates down and keep markets calm. QT is the reverse, letting those bonds roll off the balance sheet. These tools help guide long-term interest rates, even without touching short-term ones. Second, forward guidance. Sometimes, the Fed just talks. By signaling a pause or saying it's watching volatility, it can calm markets, without lifting a finger. Third, term repo funding. Instead of overnight loans, these last days or weeks. They give markets breathing room, especially when large trades can't unwind quickly. The Fed used them in 2019 and again during the 2020 COVID shock. There are other tools, like the standing repo facility or emergency lending programs, but those come with stigma and political baggage. They're not the Fed's first move. In 2019, repo markets cracked. The Fed responded with targeted liquidity support. In 2020, when COVID broke the Treasury market, the Fed launched QE, opened term repos, and restored stability, quietly. That's the modern Fed put in action. It's not about bailing out Wall Street. It's about keeping credit flowing, markets functional, and long-term yields under control. It's quiet. It's technical. And that's exactly why the market still believes it's there, even when the Fed says nothing at all. If you found this helpful, give it a like, it really helps the channel. Subscribe for more financial stories that actually explain what's happening. And drop a comment. Do you think the Fed put is still alive, or is the market too hopeful? This is Working Moms Work. Play. Recharge. Repeat. Let's keep making sense of the market, one smart video at a time.